the activity from yesterday's session with respect to the Nifty and the slide that you saw towards the end of the session, was this a case of continued manipulation on the expiry day as yesterday was? And Sajith is here to tell you about a step-by-step explanation that he's pulled up based on several parameters that he's looked at as well. The derivative data is on the screen. So Sajith, over to you.
That's right. Even if Jane Street is not in the market, there are other whales which are there and manipulating the options market there. So there is a market manipulation, especially on the expiry day, with respect to how premiums and calls are being written. And that's what we're going to show you through a step-by-step process here. So if you look at the day, how entire expiry day charts for call and for put, there's a call line graph there in the middle. You see what is the Nifty closing at 25,111, and then you have the call which closes on a decay value which is there. This seems a little complicated, so we'll just break it up for you into three halves. The first half being that you have a pre-expiry or expiry -1, where we have seen a lot of call writing happening going into the expiry, which is on Thursday there. The second thing which we're going to explain is between how 9:15 to 10 a.m. we have seen what kind of activity which has happened, and the third is after 2:15 what has happened there. So if you look at the first component, which is the expiry day 9:15 onwards, what we have seen is call writing has been witnessed, and 25,200, which was the at the money strike, had the highest open interest and resistance and that was a resistance for the market. Subsequently, what has happened is that you're seeing writing a call option at the open which was trading at a very high premium, and subsequent and buying of puts at open which was witnessed, which was at very low premium there. Post that, if you look at after 2:15, call options were allowed to decay to near zero, because it's an expiry day, so the call premiums will move towards zero to coincide with the market price or the strike there. And we've seen a sharp writing of puts coming in, which rose after 2:15, and the premiums went up to as high as 96 rupees there. So that was one of the things which is there. Now let's break it up, what happened after 2 o'clock. You can see the Nifty, how the Nifty started falling, and that's primarily because there were shorts which were created, especially in the IT stocks it was created, and as a result of which Nifty closed at 25,111. What happened to the put is it went all the way to 96 and closed at 88.4. And what happened to the call? It decayed gradually to 5 paisa. That's something which is a natural phenomena on an expiry day for calls and put, because they converge to the strike price. But what we saw here was a put there, because because of the shorts created in the market, the implied volatility went up, and as a result of it, the premium went up and closed at 88.4, thereby making a killing for the for the put writers on the expiry day.
Very important and very interesting data that you've pulled up, Sajith. I'm just wondering, Kush, what you thought of this breakdown of analysis and how different it has been to other instances in past expiries. Can you tell us if you've pulled up any data?
So, Alex, this is a little interesting, and I'll tell you why. You're questioning the very basics of how, I wouldn't call it basics, how market participants had started accepting that volatility to rahega expiry hai. Correct? It's like teaching a tiger how to purr. I mean, you can't do that. It'll roar. Expiry hai, volatility to rahega. Correct? I think we can break this down further into two key components. First is the Jane Street impact. Has there been any impact post the Jane Street announcement that came out by SEBI? And the second part is volatility on expiry day. Let's start with the first one. If you see the SEBI data, for the last 4 years, the total losses that the retail traders have made in derivatives is close to 2,86,000 crores. Correct? The Jane Street profit for the last 2 years has been about 36,500 odd crores. That is just about 12% of the overall losses that the retail traders have made, which means as Sajit also mentioned at the start of his conversation, there are other players also. I mean, you could attribute some to HNIs and some to small prop desks here or there, but you can't have the 88% coming out of these small players, right? So there has to be some other participants involved very clearly. So that's the first point. Second, has there been a Jane Street impact? There most definitely has been a Jane Street impact. What Sajit mentioned was the intrinsic value change, or what we call delta, correct? You read the change in the landscape of options through walls, right? Now, for an ATM option, a weekly option which is 5 days out, the implied volatility, the walls used to typically be around 15, never below 12. Right now, it's at 9. Which means there are definitely some supply pressures, some algos being distorted. So definitely that Jane Street impact has come about in the last 2.5, 3 weeks.
But specifically on the diversion between the put and the call,
right,
and the fact that the call was allowed to decay and the put premium on the put rose very substantially, and so therefore put writers made a killing. Specifically on that, was that leaning towards the possibility of manipulation?
So again, as I said, this has perhaps been the nature of the beast. I don't blame this particularly to Jane Street. And let me give you one more instance for this. COVID, pre-COVID, that's how I think we'll see Indian market financialization going forward as well, right? Has anything changed pre and post-COVID in terms of the expiry day volatility in particular? No, it hasn't. Correct? Somebody, some broking firm would have trademarked, Hero Zero Trade. But ये तो बहुत पहले से चल रहा है. I've been professionally in the market since 2008, much longer, if you don't count the professional aspect, but I've been there since 2008. Derivatives में ये तो हो ही रहा था. It's something that traders were anyway doing, correct? In fact, they graduated to strangle trades. You know what strangle trades are, right? 100 रुपए ऊपर का call खरीद लो, नीचे का put खरीद लो, and then you might have one big move somewhere. Okay. That has not changed. That has not changed over the last 2 decades. Okay. So I don't think there is any change. Also, one last point on this is that the retail, okay, the rise of the retail trade that we are seeing, this is in derivatives specifically, is the dark effect of the financialization of savings that we've been talking about. We've all discussed how beautiful it is for the mutual funds to have that kind of cash. But just to give you numbers, about 2018 thereabouts, the daily volume on derivatives used to be about 1 lakh crores, correct? That shot up to 400 lakh crores. And at the same time, the retail participation went from 2% to 41%. Now, you're talking Insti versus retail. It is never a fair fight. It's like fighting Tyson, in the ring with your hands tied, your ankle weights on, and eyes closed. You are never going to win that fight. You can educate it to you can educate retail to an extent.
Would you blame Tyson for it?
Absolutely not.
Correct.
Absolutely not.
That's the point at the end of the day.
Yeah, it has to be a structural change where let Instis fight it out.